Hello and welcome back. Today, I'm not going to do a market scan. There isn't going to be any Iran analysis. I know there's been a request for that. Today, I'm going to do the gold video. It's been long anticipated. It's going to be the gold investing guide. I have a lot of charts, I have a lot of stuff set up for it. I know I'm in full screen. Hello. So, don't worry about that. Sound is looking good as well. But before we get into that, I would like to announce the sponsor of this channel, which is me. So thank you. And also, if you like this video or these types of videos, investing and mostly trading, feel free to hop in the Discord. It'll be linked in the description below. Nothing there is for sale, nothing is monetized, none of that. This is just a trading journal, essentially. And now it's an investing journal as well. All right, let's get a bit into. I had prepared some stuff, and I'm sorry that the guide came out a bit later than I wanted. I've been pumping out a lot of market scans, but came to the realization that market scans is something we can always do. And when a market scan is over, no one's gonna rewatch that. But this gold guide, I'm gonna pin in the Discord. It's gonna be in the gold guide, like with the text and everything. I'll show you in a second. So it'll be there forever. So it's a pretty important video to get out. It fits well with the stonks guide. All right. So I'm gonna make myself smaller now. Look at that. That's magic, huh? All right. There we go. Is that too big? I don't know. I have no idea because now I can't see myself anymore. So I don't know. So it's an addition to this guide right here on gold that I wrote, which is also an addition to the stonks guide I wrote here. General investing advice, very general. We're talking about buying SPY here, how the average speculator does, and that kind of stuff. And now here comes the continuation, which is gold. It is a pretty natural consideration, in my opinion. Here's my hedge fund, the new logo, by the way. I hope you like it. We're going to look at a few charts when we're doing it. We're going to go through a couple things just to get things into perspective. I've got them all ready and lined up here. And also this sleeve that I posted yesterday, this one right here, we're going to go through and I'm going to make an explanation for it as well. I also want to say that for this video today, I want to explain it as simple as possible. Because I'm an economist. I have a MS in econometrics. I have taught at university. And I really hate when things are explained in this overly intricate way. And it's deliberate as well. When there is no need for it. These concepts can be explained in such simple terms. So my goal here today is for you to be able to understand it regardless of what your experience level is. So keep that in mind when I'm explaining things. If it sounds like it's simplified and you've been in the Discord for like 6 months, I don't know, you're trading, you're investing, that's why. It's not because I think you're dumb. Or maybe I do, but it's I'm just kidding. But it is because I want everyone to understand it. Just I did the same with the stonks guide. There is no point in trying to sound smart with it. I just don't see the point. And also I also have this I've always had this feeling that if you can't explain things simply, do you really understand them? I don't know. I guess there's some things you can't explain simply, like physics and stuff, but this you can. All right. So first off, let's have a look at SPY here. This is on a 1 year basis. I'm glad it got to the point where it pulled back on the potential Iran ceasefire. Here we have RGLD, which is a gold miner that I buy, that I hold, that I personally hold myself. This is my diversification for my hedges. And here is Barrick's Gold. They're called Barrick's Mine Me now. I'm so old, I still call it Barrick's Gold. I always used to say that like 10 years ago. All right, so and at the end here, we got my buddy ABX. Yeah. Did I fuck them up? I'm dumb, bro. No, I didn't. Okay. I just forgot about the merger. I didn't see the ticker difference. Don't worry about it. I thought I was gonna have to re-record there. All right. So first off, before I get into all that, I'm gonna go on full screen again and explain a few things. Hello. I'm gonna go into the basics again. That's explained in the guide for how to buy gold. When you're buying gold, there are a few very simple rules you want to follow. Very, very, very fucking simple. Avoid buying physical gold. Don't do that. Don't watch Ben Shapiro and his Birch Gold bullions. It's marked up. You're not buying gold at or anyone for that matter. It doesn't even matter who. Don't buy physical gold. I have 24 karat gold necklace right here. It's expensive as fuck, and they're always marked up. It's not resellable. They don't come at spot price. 24 karat is 99% gold, by the way. They never come at spot price. And if you manage to buy a bullion at a spot price without delivery or anything, even if you manage to do that, if you got a store in your city or whatever, the buybacks are never gonna do you good when it comes to giving you spot for reselling it as well, because they're gonna want to have a spread on it. It's very simple. When they buy and sell gold, spread is the difference between buy and sell price. When they buy and sell gold, they're gonna want to make more off it, right? They're gonna want to make a profit, so they're gonna upcharge you, and they buy it, and they're gonna cut you out when you're coming to sell. So stay away from physical gold. People end up not making money off it, and even if they just mark you up a percentage point when you buy it, say you have really favorable conditions, you got someone selling gold just 1% markup, like right down the store, or like right down the road, 1%, and then they buy back at like 2% below spot. That's terrible, bro. That's gonna cost you a ton of fucking money in the long term. As you develop as an investor, you're gonna see the importance of each percentage point and how much all of them matter. We all know how much it matters when you're trading. You know, if you do 2% 1 month or 3% 1 month, it is a huge difference, and I want you to value every percent. So don't buy physical gold. Just don't. I mean, if you want a necklace and stuff, yeah, whatever. But don't do it to invest. I don't see the value in that. If you're like incredibly rich, and yeah, I guess you can do whatever you want. But for the general investor, don't do that. So what do you do then? You don't buy physical. We go on to the ETF. What do? Do you just buy GLD? The GLD ETF? Paper gold? No, you don't want to do that. What you want to buy is something even better. You want to buy a gold miner. And I also recommend reading the book Rich Dad, Poor Dad. Kiyosaki or whatever the fuck his name is, he explains that pretty well. I mean, he's kind of a fanatic. He says, I buy the fake money and buy them, or I borrow the fake money and then I take the fake money and buy the real money. He's got ideologically into it. I'm not. I just want to make money. Don't give a shit if it's fake or not. Don't care. Just trying to make money off it. So you want to buy the miners. And not just any miner at all. You want to buy the big ones. You want to essentially buy, they're not blue chips, but in the gold industry, you want to buy the blue chips. A blue chip or S&P 500 stocks like for example, Apple, Amazon, Alphabet, that's Google. Any of those, okay? And now we're going to look into that. So follow my principles. Don't buy physical. Don't just buy some goofy ass GLD random ticker. And buy a nice miner that pays you a dividend. The dividend part is important. I'm gonna make myself smaller again, and we're gonna look into that now. I just want to set the presets before I delve into things, so that we're on the same page. I caught SPY in a pretty bad period here. It's been very volatile with the Iran war and that kind of stuff. So even though it looks like all these miners are beating SPY on the 1 year, which I took the screenshot of, and also noted in my Discord, keep in mind that you should not just buy miners. They do not beat SPY. They don't do that. They don't do that. And they're already pulling back because the war is over. But that's where the interesting part comes in. Gold is generally a hedging asset. I'm saying generally because states use it for other things. For example, China uses it to de-dollarize. But you as an individual investor, you're going to buy it as a hedging asset. A hedging asset that you hold against SPY. When you do that, I want you to follow the rules of the good old Benjamin Graham. And I really recommend that you keep this or buy this book right here, The Intelligent Investor, Benjamin Graham. One of the best books I've ever read on investing. I've never heard anyone say anything else either, bro. Like ever. Everyone loves that book. So you don't want to have a large portion, like Benjamin Graham explains, of your portfolio as speculative. Actually, if you're new to this, I would recommend that you don't do this at all. Don't buy gold. Don't buy any of these miners. Just buy SPY and just average into SPY. You're most likely going to be better off by doing that. But I know people are going to speculate no matter what. It's kind of like saying, oh, just never drink alcohol again in your life. You'd be good. They're gonna drink, bro. Give them some proper advice. Stay away from that brown liquor. Give some proper advice. So here I am, giving proper advice, and this has helped me actually gain an edge on SPY, and I'm gonna show you why here. First off, the miners I bought is ticker B, ABX, and RGLD. These I use in a 1 to 10 hedging, or I hold them 1 to 10 hedged against SPY. Like I explained in my guide here, you're going to have to read this to understand the video properly. But I use the example of $1 million portfolio. 1 to 10 means that you would put $900,000 into SPY, and then you would put $100,000 into these miners, these gold miners. You don't want to be like Epstein. You want gold miners here. You want one that pays a dividend. And you can see here, the dividend yield is down here. These guys pay 4%. These guys pay 3.8%. or 3.9%, and 0.7. This is RGLD. This one has exploded in growth. They can't really afford to pay that much. So, but why would you do this? It is due to the inverse relationship that these hold. And because we're in the volatile period we're in now, you can see that, oh, it does not go bigger because of my screenshot. No. So, yeah, because of the volatile period we've been in with war, with them doing QE, some money to Iran, inflation, that kind of stuff. But mostly the Iran war, oil prices. I mean, QE and all that comes back to that. But here, well, I can do that. Oh yeah, I can zoom in like that. Okay, so here it fits well with what my example is. SPY is just up 22% this year. It is close to all-time highs though. So you might not have the ability to lower your average price still. But just a couple weeks ago, you might have, if you were averaging in. And if you don't know what that means, read the Stonks guide. It's quite important. So when you're averaging in, your average price is going to be somewhere around, it's going to move like a moving average. So it's going to be an average of SPY. You know, when you see those Y equals 1 correlations like that, it's going to move with SPY, your average price. And it's gonna move less and less the more you've averaged in, because you've bought more and more. And in this time period, 1 year, 23 SPY is up 23%. That's really good. That's really good, right? It's not bad for a whole year. I mean, what the fuck does it average? 10, 9? I think it's about 9 now. Something like that. So it's been a good year. But in the same time period, we have here 62% growth with RGLD. And where does it even say the ticker? I can't see the ticker, but I recognize this is RGLD, the Royal Gold. If you want to go check them out, this is the one I've been holding the most of and for the longest. If you hop on the 5-year, this shit is up like 1,000%. It exploded. It's up more in that time period. Here we have ticker B. We're up 126%. Ticker ABX, we're up 122%. And why is that? Why, like, what the fuck? What is going on? Why are these miners up 100% now when the gold surge has ended? I'll show you. The explosive growth in gold has slowed down. Right here, you can see, we're not worried about this. Right here, we had this explosive period. The miners were up even more. And now we've gone kind of back down again. It's ranging normally again. I didn't want to make the video when it was like that because it's not representative. But this is where it all ties in. These miners, your gold is not going to beat SPY on a long-term index. So if you just hold it, if you just hold these for 20 years and compare them, they won't beat SPY. Even during the most explosive gold periods and volatility and everything. I added in this chart as well to show you. This is the most favorable gold chart you can get. And you can still see that SPY is ahead. And here you can see the financial crisis and what it did to gold prices, because it is a hedging asset. So if you had 10% of your money in gold here, you would have had the ability, if you had a set rule, which I'm going to get into, to buy a lot of SPY and end up a lot higher at a higher baseline than you would have already been at. I'm going to open the illustration that I made in the gold guide. Oh, I already have it here. What am I talking about? For a sleeve. It is very, very simple, in my opinion. You hold these miners that are on a drip, a dividends reinvestment plan. And you also average into your miners, just like you would, your gold miners, like you would with SPY, and you wait for a SPY drawdown. Drawdown. Not just any drawdown, but you're waiting for a drawdown where your average price is dropped. And you set a certain rule for when you dump your whole fucking miner. Let's say your rule is 20%. SPY, your average price is down 20%. You dump your miner, you buy all of that into SPY, and by the time SPY recovers, in that same time period, your miner will most likely have grown more substantial growth than SPY has had, and you'll get to lower your average price. So you'll have that extra built up capital that you've been averaging into. It's been on a drip, it hasn't been touched, and it will most likely be explosive because people are panic buying into gold during periods like those. So you'll be up a lot, like we can see now. You'll be up like 100%, while SPY is up 20. And you can imagine with the inverse relationship, maybe you're up 300% if SPY is down 20% instead of up. Also, if you want to be more pessimistic, you can go 30. If you want to be some recession scared motherfucker, you can go 42, but that's very rare. And as I have noted here, miners rally and outperform during these periods. So you rotate them out, like I've written here. You sell the miners, buy more SPY, and at a discount. Remember to keep that, like I said in the stock investing guide, you want to do it, or you want to have the mindset that it's at a discount. That's the only thing that happens when SPY is down. It's not like you've lost money, SPY is down, blah, blah, blah. If you're thinking like that, you have already fucked up. The only thing that's happening is SPY is at a discount. So if you have a set rule, you get some way to monitor this. Your average price is down, or your average cost basis price. So what you paid on average for SPY is down 20%. You dump all your gold, you buy SPY. You're most likely going to end up with a hedge here. A successful hedge. And here you can see I've made some charts for it as well on how you can gain an edge on that. So yeah. Then there is also the inverse thing. When you have, remember, if you do this, when you then buy into SPY again, and SPY starts recovering, you also want to start buying the gold miners again, because it is an infinitely repeating cycle. It is a cycle that has worked for me to get a small edge on SPY while essentially just holding SPY. It is quite simple. It is not very hard. And you might ask, okay, so when do I buy Royal Gold back? Well, you've got to set a rule for that as well. That's why I always preach having a little notebook, like I do for your dynamic. Setting up a dynamic, even though no one seems to give a shit, but set a rule for that as well. Generally, it would be a good time when your average price is way above what you're buying SPY at to leverage more into miners. And you can use the inverse relationship of when your average price is over 30% with you averaging in. You can't just leave it and get up 30%, but when you're averaging in and you're 30% above, you can open that 30% hedge again. And I would recommend keeping the same relationship to them. What I mean by that is if you're looking for a 20% drop to buy with a miner, also look for a 20% average cost basis price for when you buy back in. And this here is a perfect setup in my opinion, because you're going against what always fucking fails. It's fear driven buying. People are panicking like shit, SPY is going down. They're selling and buying gold. And your gold miner is going to make money off of that. And you've already been preparing your gold miner. And when everyone is panic buying that, you sell. And then when everyone is panic selling SPY, you buy. And if you're worried about like things such as what if SPY goes down further? Who gives a fuck? Honestly. If you're worried about SPY going to zero, I don't even know what to tell you, because if SPY goes to zero, the world economy is over. We're at the Stone Age. It doesn't matter at that point. So it's like a bet you can't lose. But what if I buy it at 30% and then it goes down 40? It's gonna recover. We've always had credit cycles. That's just the way it is. I don't want to get into credit cycles, how they work, because the video will become too long. And I think I already have a video on that. It's kind of hard because I have over 200 videos now. So, in the interest of not making this too long, I think I have explained it pretty well. I've given some recommendations for tickers as well. Don't look at these numbers and be like, yeah, Barracks is the best. Ticker B, I'm going with that. Nah, I'd recommend RGLD. Yes. Yeah, we can look at it too. So yeah, so you're on the full basis. Yeah, so I bought this shit at like $40 a stock, and then it went up to like 400 or some crazy ass shit. No, let me see. Oh no, to 300, not 400, or almost 300. Yeah, almost 1,000% because people are panicking, and I made good money off of that. I dumped a lot of it. So as you can see, 10,000% for Royal Gold. They've been doing great, and I like the fundamentals of the company. But there is nothing wrong with any of the other miners here mentioned as well. And keep in mind, this here is the best case scenario for gold there is. And if you look at this outliner here, if you had some Bollinger Bands or anything like that, that's an oscillator. You could see that this is out of whack and it's going to go back in and range back in. And you could have pumped your SPY with that. So with the interest of keeping this within a reasonable time frame, I'm going to end the video here. I really hope it was useful. I really hope I explained things in a way that is or was super understandable and is super understandable. If you got any questions, feel free to leave a comment on YouTube or just hop in my Discord, ask me anything. I always answer questions in my Discord. And on that note, I'm going to end it right here. Thank you for watching, and bye-bye.